Another error that a lot of traders overlook is that we don't expect price to hit these levels and reverse immediately. I like to think of support and resistance zones as magnets, and the best setups are when... In this video, I'll be explaining how to draw and place support and resistance zones correctly, and what mistakes most traders do when entering trades. Stick around until the end, it's only a 10-minute video, so let's get into it. Support and resistance zones are areas where price historically likes to reverse, but a lot of traders often misinterpret these areas, and there are generally three mistakes that they make. Firstly, although price has bounced off this area 3 times, we shouldn't draw a support and resistance zone here. Instead, it may be an area of supply, and similarly, where price has bounced off this area a couple of times, this could be an area of demand rather than support and resistance. Another couple of areas are up here and down here, where we would not be drawing support and resistance zones. I'll create another episode on supply and demand, so be sure to subscribe and visit my channel for future videos. Now, as the name suggests, for a zone to be valid, it has to pass through multiple areas of support and resistance, such as this, where it hits support, breaks through, and then turns into resistance. A general rule of thumb is that price has to hit a zone at least 3 times as support and resistance for it to be classed as strong enough to mark up on our charts. Another error that a lot of traders overlook is that we don't expect price to hit these levels and reverse immediately. I like to think of support and resistance zones as magnets, and the best setups are when price is attracted to these levels, pushes past, and then rejects, and then is repelled away from the zone. Let me explain what actually happens here. Trading is a psychological game, as we should all know by now. Therefore, price may look ready to turn, but people will wait for a support and resistance zone to hit before cashing out. So price will automatically get attracted to these areas when close by. What happens next is a few greedy traders will hold on to positions for a few extra pips, and as the prices push past a zone, we get new buyers entering the market prematurely. As price pushes up, the original buyers will cash out, causing price rejections and wicks back below the support and resistance zone, and then repel away from the magnetic zone, taking out all of the stop losses from the new buyers. Price generally is attracted back to the zone when this happens, and all the professionals will put sell orders on, causing price to repel away from the zone again for a continuation down. In the end, patience always pays, and this is also the reason you can never just trade support and resistance alone. In short, don't set sell limits at support and resistance or buy limits, because what you want to see is a break of the support and resistance zone and a rejection back to it. These are high probability setups, and you'll also have a clearer idea of where to put your stop loss, above the wick or below if this happens at a support. The third and final gem I'll leave you with is that once you've drawn your support and resistance zones, edit the coordinates to the nearest round number. For the same reason as I mentioned earlier, trading is a psychological game, and players often like to set alerts at round numbers where they can then think about how to react. You might also find that these zones end up being at similar distances apart, like at the numbers ending in 00, 250, 500 and 750. A bonus, if you stayed to the end, draw zones on your go-to time frame and a higher time frame, as support and resistance is more consistent on higher time frames. However, pip counts will also be higher, so you'll be looking for other confirmations within the higher time frame zones. Thanks for watching, and drop a like if you got to the end.